Probability models for portfolio return and risk introduces the statistical framework used to analyze portfolio performance and risk in modern investment management. The topic explains that portfolios combine multiple assets, each with different expected returns and risk characteristics. Probability models help investors estimate overall portfolio outcomes under uncertainty by evaluating the likelihood of different return scenarios. Rather than analyzing securities individually, portfolio theory focuses on how assets interact collectively. The topic emphasizes that diversification can reduce portfolio risk when asset returns are not perfectly correlated. Understanding portfolio return and risk measurement is therefore essential for constructing efficient portfolios and making informed investment decisions in uncertain financial markets. The topic begins with portfolio expected return, which is calculated as the weighted average of the expected returns of individual assets within the portfolio. Portfolio weights represent the proportion of total capital invested in each asset. Expected portfolio return therefore depends both on the expected returns of securities and on allocation decisions made by the investor. The topic highlights that expected return calculation is relatively straightforward because returns combine linearly according to investment proportions. This concept forms the basis for strategic asset allocation and portfolio optimization, where investors seek combinations of assets that maximize expected return for a given level of acceptable investment risk. The topic then examines portfolio risk, emphasizing that total portfolio risk depends not only on the risk of individual assets but also on the relationships among asset returns. Portfolio variance and standard deviation are influenced by both individual asset volatility and covariance between asset returns. Covariance measures the extent to which two assets move together over time, while correlation standardizes this relationship on a scale between -1 and +1. The topic demonstrates that combining assets with imperfect correlations can reduce overall portfolio risk. This diversification benefit is one of the most important principles in portfolio management and modern financial theory. A key insight of the topic is that diversification effectiveness depends heavily on correlation. If assets are perfectly positively correlated, diversification provides little or no reduction in risk because assets move together identically. Conversely, lower or negative correlations significantly reduce portfolio volatility by offsetting fluctuations across securities. The topic explains that investors can improve portfolio efficiency by selecting assets with different economic drivers and return patterns. Diversification therefore allows investors to achieve similar expected returns with lower risk or potentially higher returns for the same level of risk. These principles are foundational to portfolio construction and institutional investment management practices worldwide. The topic also introduces joint probability functions, which model multiple asset returns simultaneously. Joint probabilities allow analysts to calculate expected portfolio returns, variances, covariances, and correlations based on different possible combinations of outcomes. This approach is especially useful when analyzing portfolios under varying economic conditions or market scenarios. By assigning probabilities to different combinations of returns, analysts can better estimate how portfolios may perform across a range of environments. The topic demonstrates how statistical probability models support quantitative portfolio analysis and improve understanding of complex relationships between securities within diversified investment portfolios. Another important concept introduced is shortfall risk and Roy's safety-first criterion. Shortfall risk measures the probability that portfolio returns will fall below a minimum acceptable threshold, such as a required return needed to meet future obligations. Roy's safety-first ratio helps investors identify portfolios that minimize the likelihood of failing to achieve this threshold return. The ratio compares expected excess return above the threshold relative to portfolio standard deviation. Investors seeking downside protection may prefer portfolios with higher safety-first ratios because they offer lower probabilities of unacceptable performance outcomes. This framework connects probability analysis directly to practical investment objectives and risk management concerns. The key concepts from topic establish the quantitative foundation of modern portfolio theory and risk management. The topic demonstrates that portfolio return depends on weighted average expected returns, while portfolio risk depends critically on diversification and asset correlations. Probability models, covariance analysis, joint distributions, and safety-first criteria allow investors to evaluate portfolios systematically under uncertainty. These concepts support more advanced topics throughout the CFA program, including efficient frontier analysis, capital asset pricing models, and portfolio optimization techniques. Mastery of portfolio probability models enables analysts to construct diversified portfolios, manage investment risk effectively, and align portfolio strategies with investor objectives and risk tolerance.